The analytics of a financial planning practice. We're going to learn about benchmarking your practice. Now, the objectives of this lesson is that you should be able to benchmark your practice, understand your firm's financial health, and identify areas of opportunity for your firm. So, benchmarking your practice, what do we mean? We mean converting the numbers into ratios so that you can observe trends. And you're going to want to do this over 3 to 5 years, year over year, and against industry benchmarks. The value for this is that you'll know how your business is performing, what you need to do as far as hiring or production. You'll be able to make those business decisions, as well as if you're going to set up your continuity plan or buy a practice. These will all be helpful things to know in evaluating whether it's a good deal. Now, often we look at a simple value being the present value of future free cash flow of profits. And while that's something like a quick snapshot that you can use, there's so many other things that you need in order to evaluate your practice. And so we're going to talk about those today. Primarily, there are 6 ratios that are used to gain perspective on your practice. They are the overhead ratio, the gross profit margin, the operating profit margin, the revenue per professional, and that's the advisor, people that produce revenue for the firm. Then there's active clients per professional, and then there's revenue per active clients. So talking about the overhead ratio first, it is the overhead as a percentage of the revenue that you take in. So it's used to manage your growth and expenses. You use it for budgeting. You're going to use it to weigh staffing decisions and purchases. And your goal for this is to have the lowest expenses while maintaining the service that you have set as your standard for your practice. So you can improve this ratio by reducing expenses or increasing revenue or improving efficiencies. And the method to determine this is you're going to divide your monthly overhead by your monthly sales and then multiply by 100, and that's the percentage of your overhead costs. And what it's going to show you is the proportion of expenses in relation to the total income that you're bringing in that can't be allocated directly to the production of goods or service. So what does it cost you to run your business? Next is gross profit margin. And again, this is to measure your efficiency. You want to look for a profit margin. Ideally, 25% is what is bantered about in the industry right now. And so it's used to compare how costs relate to revenue. So it gives you some insight on, can you pay your expenses? If something happened, if there's a downturn in revenue, can you still make payroll? Can you still keep your practice open and the lights on? That's why you want to have a healthy profit margin. If there's a low profit margin, then maybe the revenue's down, there's too low of pricing or too high of labor costs. And so it gives you an opportunity to invest more in technology or staff if you find that you have a very healthy profit margin. So the way to determine this growth profit margin is you're going to subtract the costs of goods that you sell from the total revenue, and then divide that number by the total revenues. So this is typically earnings before the owner's compensation. So because that's flexible what you pay yourself as an owner. So that's typically how it's done to give you a consistent idea of what your gross profit margin is. Now, operating profit margin is your net profit after all costs. So that shows you how efficient your operation is, and this is best analyzed over a period of time. You want to see a stability of revenue and expenses so that you have a really good idea of what it's costing you to run your business. So the way that you calculate this, you want, as I said, 25% or better. And you're going to take your operating income divided by your net sales. And this is before income taxes, depreciation, and amortization. Now, revenue per professional is what's going to measure your productivity. So it shows how each advisor is bringing in revenue, and is it equally divided? Is somebody not pulling their weight? Is somebody too overloaded? It helps you determine those things. So you want to look at that and determine how your firm ranks against other firms. Maybe you're charging too little for what you're providing. So if your ratio is too low, you might want to focus on growth. And if it's too high, you might need some more staff. So the method of this is asset under management divided by the number of professionals is the revenue per professional. And by professional, I mean somebody who is actually bringing revenue into the firm. Now, active clients per professional is going to give you an idea of your service level because you've seen how you want to determine how much time you're going to spend with each client. And this is going to tell you if you're meeting that goal. So it helps you determine your productivity, its value when comparing yourself to the competition, and you might be underserving clients if you have too many per professional, or you might need to increase some staff. You're going to take the number of clients and divide it by the number of full-time producers, and that includes the owners. Now, revenue per active client is another way of expressing your profitability. So it measures your profitability per client. So this will help you determine your minimum account size and then use that minimum as a consistent factor so you can see if you're growing your practice appropriately. So if the revenue per client is really high, you might have too few clients. There might be some room to grow. If it's too low, your account size might be too low, or you just have too few clients overall. So it's really correlated to the size of your firm. So the way you're going to calculate this is you're going to take your overall revenue times the total number of users at year end. So again, you should take this at the same time every year so that you can compare apples to apples. It's really difficult if you're doing it in the middle of the year and last was end of the year. It's hard to determine your annual growth. But you want to stay disciplined in your client acquisition, because as you improve this ratio, you can make sure that you're not accepting too low account values, and you want to make sure that you're meeting your profit that you've determined you hope your business will make. So in summary, you've learned about how these analytics can help you guide your business decisions, how it tracks the health of your business, and some ways to implement data-driven strategies.